What's up, team? Sean from Rest to Live here, and today we are going to talk briefly about Zim Integrated Shipping Services. Okay, stock symbol is ZIM, and the reason I'm making this video is because of a tweet that was sent my way yesterday asking how the heck they could possibly pay such insane dividend rates, absolutely wildly high dividend rates. And I think there's some major misunderstandings about the way this company operates, what they actually do, and how they make their money that can help explain partly why the dividend rate is so high, the insane amount of risk in that rate, and how it can affect stock price as well. And then additionally, I just want to speak to the fact that I do not own this stock. I do not plan to own this stock. I have no intentions of owning this stock. So full transparency, I don't have it. I don't plan to buy it. I'm most likely not going to buy it. And if I do, it certainly would not be any time in the near future for any specific reason I can think of. So first and foremost, I want to just tell you. So I have invested in shipping, container, logistics type of companies throughout my entire investing career. Typically, they are payers of really strong dividends. It's a very high capital business. So it's practically impossible to start a brand new global shipping company because you're going to have to go out and build these mega container ships, right? They're the size of football fields. We see them blocking entire canals and stopping global traffic. That's how big they are. So it's important to understand that traditionally, if you are a gigantic container company, you have generally not a ton of competition in terms of other players. Your competition, though, is global shipping rates and demand. That's the gotcha, okay? So if we look at and track global shipping rates, it's very indicative of what we can expect for earnings, which will be indicative of what we can expect to happen with dividends over time. Now, you'll see when I start sharing some of these screens here exactly what I'm talking about. But what makes Zim sort of unique is they don't own their assets. So in many ways, they're they're operating a bit like a REIT, a real estate investment trust, where they're almost, in a sense, renting the ships and then renting the containers to then rent out to people who need to ship things, right? So the services are built in. So they can sort of have this flexible model of, I need this many ships a year, I need this many ships a year. They'll sign long-term contracts for those shipping engagements. And then, of course, they'll have containers to rent and logistical services, etc. So this is not a very straightforward thought process for how we look at companies in this industry. That's why I really want to take a second here and say that again. Most of the time, you're going to be looking at these kinds of companies that will own a certain amount of major freight ships. They'll have a certain amount of containers. They'll have logistical operations at the ports, at sea, etc. Okay. They sign very long-term contracts. So typically, it's very predictable income and earnings, typically. But during times of change, it can really shift the market quickly and completely revert back to where it was during bad times or good times and the like. So I want to say this one more time, and it's not to be redundant. It's because this is not standard operating across a lot of these major shippers. They charter the ships. So to say, they rent the ships and the containers. So they don't own them. So if you read the balance sheet, you might see that those are assets, but they don't technically own them. They're just renting or leasing them, okay? So looking at a standard report on this is a little bit cloudy. It's nothing shady or anything like that. It's just you may not realize that they don't technically own them, right? So when you're looking at how much cash they have on hand or the value of their assets, they have to give those back at some point. So you're really trying to understand that differential in earnings. And like a lot of companies in this space, they do typically pay out a big portion of their earnings in dividends. So a high dividend rate for a shipping container company doesn't scare me, but let me share my screen and we'll jump on in here. And I just want to give a shout out. I won't call the person out specifically, but I appreciate you asking the question. It's great to get stuff on Twitter like this where I can jump in and show some things. So here we are, right? Currently trading at $17.23 a share. It's down a little bit today. And this is Zim Integrated Shipping Services, ZIM, as I said earlier. The upcoming ex-dividend date, right? 4/4/2023. We've already passed that. And it has a current dividend yield. This is not a typo, of 131% payout. Team, I think it's safe to say we can all agree there is no way that can be sustainable on any level. they're paying an annual dividend of $25.60 with a PE ratio of 0.46. So let's just take a pause for a second. If there was a company, I'm not talking about Zim, I'm talking just the theoretical magical money machine of the world we live in. If there was a place where I could invest $17.20 something and get back $25.60, I would literally be the wealthiest person on the planet, because I would borrow money at such an insane rate from everyone from anywhere that I would just dump it all in here and then immediately make 131% yield on my money. I want you to think about why that's not sustainable, right? They would have to continuously find a way to exceed earnings at insane jumps, constantly, never ending, while somehow still reinvesting the business to allow for those gains. So I'm going to show you something in a second to help explain this a little bit more. But I want to call out, this is where the question came from, was that obviously this doesn't make sense. And I think it was a great question to ask, well, why the heck is this happening? But just to call out too, you can see some things here. They pay traditionally really good dividends, but we've had some wild ones here, down as low as $2 a quarter, all the way up to $17 a quarter. And then more recently, we've seen $4.75, $2.95, $6.40, right? So they're still pretty darn good. What I do want to call out, though, is if we look at the summary of the stock here real quick, this isn't the stuff I really want to show you, but it just helps to set the stage. You can see here that over time, right? Excuse me. Let me just close all this down so it's easier to see. I got ads popping up all over the place on my screen here. So just give me 1 second. There we go. And if I can get the one up top to go away, there it goes. So we look at over 5 days, right? Over a month, we can see a pretty big drop after going up there, right? Over 6 months, year to date, you can see the 1 year. We can even take a look at the 5 year here, just to give you an idea. And this is very indicative of what I'm about to show you. So the stock was trading as high as, the high 80s, right? $88 per share. And we're currently sitting, again, like I said earlier, sort of in this $17 range. So we've already seen some major pressure of the stock coming down. Now, if you don't normally watch this channel, or you don't really know how dividends typically work in terms of payouts, I'm not going to give you a full-blown diatribe here, but just a quick piece of understanding. Typically, when companies see share prices crash down like this, what will usually follow is a lowering of the dividend to be back in line with a reasonable rate. So number one, my key risk call out here is that they can't simply be paying dividends this high with yields like that, but it's based on earnings that are locked in from contracts. When those contracts reset and they have to write new contracts based on new shipping rates, earnings are going to come down, which is going to lead to dividends coming down because the share price is going to come down, right? So just keep that basic understanding in your mind. Yes, it's more complex than that, but you don't need to think about it in a more complex way sometimes, okay? So you can see what's happening here. You understand that they're renting their equipment, they can scale as needed, but they're susceptible to freight rates globally. Let's take a look at global container freight rate indexes from January 2019 to March 2023. And team, I really hope you're seeing what I'm seeing here. This market has been extremely stable for quite a bit of time. It's shot practically straight up, and it's been slowly coming down since then. So any contracts that were written in these areas, right, are going to represent really high freight rates that no longer exist today. So assuming you have a 3 or 5 year contract, maybe even longer, you're still paying these kind of rates, but you, as the person who's paying for it, is going to be consistently looking for ways to lower it, to cut it, to try to renegotiate or recontract that deal. Maybe you can't, but you certainly will when the contract expires or renews. And you can see here, we're sort of falling back down to that reasonable rate we would expect for global shipping. The pandemic affected things in a big way in terms of shipping rates. But again, follow the path here, right? This is what the shipping prices look like. What does the stock price look like? They're very tied together. So those earnings are going to follow and drive the stock price up. Now, if you think about for a second, if the stock price was times 4, the yield of the dividend would be divided by 4. So that 130 becomes what? About, excuse me, 30 and change percent. Still a wildly huge dividend rate, but not 130+%. So my call out here is this took me all of 5 minutes to grab the information, tie the international rates to the change in share price, and match it up against where the dividend probably will likely be when earnings reset. So all this is to say, I'm not determining whether it's a good company or a bad company. I'm not determining whether you should or shouldn't be interested in this stock or dividend. But from my perspective, I see a ton of very predictable risk here that's going to follow what makes a ton of sense. The statistics and the way the stock moves and the way the market freight prices move seem to be very aligned here. So I would be looking for a major dividend cut in the future, which is going to further drive the price of the stock down. So you have to understand, are you going to be in a position to do really one of two things: make up for that drop in price and really try to balance your dollar cost average your way down? Probably doesn't make a lot of sense to do something like that, in my opinion. I wouldn't get into something that I think is going to go down no matter what the payout is. Or do we think that for some reason this is going to shoot back up? Because, team, even if it jumps up a little bit, if you're not looking at these numbers, I want you to see this. We're sub 2000. Okay. And we're back to sub 2000. This was freight rates were 5x that price. Do we see something coming down the pipeline in the near term future that will sustainably 5x the price again? I don't, but I don't know everything. Maybe you know something I don't. If you do, my gosh, drop it below. I'd love to hear it. So this is sort of my thesis on what's going on here. This is my explanation for why Zim pays such an insane dividend. And look, the truth is, maybe when this thing stabilizes into a more reasonable dividend yield that still is probably going to be pretty big, maybe then it makes sense to get into it. But I don't have that information, and I don't know what the right play is. So, team, with that, I just want to say, as always, thanks for watching. I hope this was helpful. Let me know what you think down below, and we'll see you soon. Thanks, everybody.